Welcome to the video on whether building credit with an auto loan is worth the risk. We will explore how first-time borrowers can balance credit building with financial stability. We will also discuss approval factors like debt-to-income ratio and employment, compare credit unions versus banks, and outline strategies to maximize your approval odds while protecting your budget. Finally, we will include quizzes and a practical roadmap you can follow step by step. Here is our agenda. First, we will frame the core question of credit building versus affordability. Next, we will identify the main loan approval factors. Then, we will run through a realistic affordability check. After that, we will compare credit unions to banks. Subsequently, we will cover practical steps to improve your approval odds. We will also share budget tools and examples. We will test your understanding with a couple of quick quizzes. Finally, we will summarize and give you a clear action plan. Before we proceed, this content is educational and not financial advice. Your situation is unique, and you should consult a qualified professional before making borrowing decisions. Additionally, we will use illustrative numbers for clarity. They are not guarantees or offers. To begin, we pose the central question: should you take on a small auto loan to build credit, or instead prioritize cash flow and buy a cheaper car for now? The decision hinges on your debt-to-income ratio, employment stability, and the true all-in monthly cost of car ownership, not just the loan payment. Now, let us review the approval factors. Your credit score is only part of the equation. Lenders weigh debt-to-income ratio and employment stability heavily. If you have a thin credit file and a mid-600 score, a $6,000 to $7,000 loan can be realistic if the rest of your profile is strong. Part-time income is acceptable, but a 4-month work history is considered fragile by many lenders. Consistency of income is more important than the raw dollar amount. Marginal income around $1,200 per month is a high-risk signal because it leaves very little room for loan payments and ownership costs. A larger down payment reduces the loan-to-value ratio and can offset concerns about a short employment history or moderate credit score. Next, we turn to affordability. The car payment is only one piece of the puzzle. Insurance, gas, maintenance, and registration costs can collectively strain a low monthly income. When income is tight, many advisors recommend paying cash for a vehicle under $5,000 and postponing financing. The bottom line is that you should not finance for the sake of building credit, if the monthly burden will jeopardize your basic expenses. Moving on. Here is how lenders typically evaluate you. Credit unions frequently consider the broader member relationship and may be more flexible with thin files or limited histories. Large banks usually rely on stricter metrics and may be less forgiving, leading to higher interest rates or denials for marginal profiles. Now, let us compare credit unions and banks. Credit unions often provide lower rates to first-time borrowers, consider the overall member relationship, and show more flexibility towards short employment histories. They may also offer financial counseling, making them a strong starting point for responsible credit building. In contrast, banks typically enforce stricter credit score and debt-to-income thresholds, are less forgiving with thin files, and may quote higher interest rates to compensate for risk. While banks can produce faster decisions, they generally offer fewer exceptions, making them more suitable for borrowers with established profiles. Subsequently, here are concrete steps to improve your odds. First, target a modest car with a $6,000 to $7,000 loan size. Second, bring a 25% to 30% down payment to reduce loan-to-value and potentially your rate. Third, pursue pre-approval at a credit union before shopping. Fourth, keep your debt-to-income ratio under roughly 36% and certainly under 43%. Fifth, demonstrate consistent income. If your history is short, waiting a few months can strengthen your case. Sixth, obtain insurance quotes before applying so you know the full monthly cost. Seventh, budget for gas, maintenance, and an emergency buffer. Finally, enable autopay and make every payment on time to build a positive credit history. Continuing, let us arm you with simple tools. Your debt-to-income ratio equals total monthly debt payments divided by gross monthly income, multiplied by 100%. Boost. Use a checklist. List your income sources, tally current debts, estimate the new car payment, and add insurance, fuel, and maintenance. Confirm you maintain an emergency cushion. A practical rule of thumb is to keep total car costs under 10 to 15% of take-home pay when income is modest. If that is not feasible today, consider paying cash for a car under $5,000 until your income increases. Next, consider this illustrative monthly budget for a $1,200 take-home income. The proposed car payment is $220. Insurance is $150. Gas is $120. Maintenance averages $50. Registration and taxes average $25. The total car-related cost is $565, which represents approximately 47% of take-home income. This demonstrates how quickly car costs can dominate a tight budget. Quiz time. Which factor most often makes or breaks a first auto loan approval when your score is in the mid-600s? Option A, the exact credit score alone. Option B, debt-to-income ratio and employment stability. Option C, the car's color. Option D, whether the car is new or used. You may pause the video now to think about the answer. We will discuss the answer in the next section. The correct answer is B, debt-to-income ratio and employment stability. Lenders need to see that you can comfortably make payments from a consistent income stream, which often matters more than a small difference in credit score. Next quiz. For first-time or marginal borrowers, which lender type often offers more flexibility? Option A, large commercial banks. Option B, payday lenders. Option C, credit unions. Option D, online marketplaces only. You may pause the video now to think about the answer. We will discuss the answer in the next section. The correct answer is C, credit unions. They often emphasize member relationships and are more flexible when dealing with thin files or limited histories, especially compared to large commercial banks. Now let us visualize a timeline to build a strong down payment over 4 to 6 months. In month 1, open a separate savings account and begin tracking every expense. In month 2, reduce recurring subscriptions and negotiate insurance rates to free up cash. In month 3, add income via extra shifts or a side gig. In month 4, sell unused items to accelerate savings. In month 5, simulate a future car payment by automatically transferring that amount into savings to test affordability. In month 6, finalize pre-approval with a credit union and shop within your preset budget. Here are the key takeaways. Debt-to-income and income consistency matter more than small differences in credit score. If your income is tight, consider paying cash under $5,000 and waiting to finance. Credit unions often offer better first-time terms and flexibility. A 25 to 30% down payment meaningfully improves your approval odds. Always budget for the full ownership cost, including payment, insurance, fuel, maintenance, and taxes. To summarize, building credit with a small auto loan can make sense if your debt-to-income ratio is healthy, your income is consistent, and you can comfortably cover all-in costs. It is unwise if your monthly cash flow is marginal. In that case, buy a cheaper car and reassess later. For many, the optimal path is a small $6,000 to $7,000 loan, combined with a 25 to 30% down payment and credit union pre-approval. Above all, protect your financial stability before prioritizing credit score improvements. Before we close, thank you for watching. If this video helped you, please like, share, and subscribe. In the comments, share your plan. Are you pursuing a small loan with a strong down payment, or choosing a cash car for now? Your insights may help others make a better decision.